Good morning, everyone. My name's Michael Judge. I'm calling on behalf of OFX. We will just give everybody on today's webinar call, I think just another 30 seconds or so before we start, before we kick off. Thanks to everyone that's joined so far. We'll just give everybody another minute or so. We still do have quite a few people jumping on the call now, so we're about 60 seconds away from the start. Okay, I think we're ready to take flight. Welcome everybody to the OFX Foreign Exchange and Cash Flow Management webinar. My name is Michael Judge, and I'm the head of Australia and New Zealand here at the OFX Group, responsible for the core consumer and corporate businesses. Very excited to be teaming up today with one of our partners, and in doing so, introducing Eleanor Casapetes, who is the tax policy advisor for CPA Australia. Delighted to have Eleanor join us today. Eleanor has spent 17 years at the ATO. Prior to her time at the ATO, she did spend 17 years working through tax policy and advisory forums. At the moment, she does lead the CPA Australia Taxation Centre of Excellence, and she does represent the CPA of Australia on a variety of tax-related forums and groups. Just to give a little bit of an orientation in terms of what we will be covering today, I think it's very important to baseline the conversation in terms of some global market events and obviously some of the dynamics which we are observing in global markets today, as well as obviously baselining the conversation against our observations for the Australian dollar in particular. Once we've grounded ourselves in today's market, we will be pivoting across to speaking a little bit around obviously some simple tips around how to manage currency risk, obviously providing some recommendations to the business audience around how businesses can navigate, an increasingly volatile environment. Towards the back end of the webinar, we will introduce Eleanor, who will be speaking about some of the government relief packages, which obviously been part of the post-COVID environment, as well as, again, providing some cash flow management tips for the audience as well. As said, first things first, we do want to jump into the market as we see it today. I think first things first, it's really important to note that the way back to early 2020. I suppose there was a perception that markets were acting a lot exchange rate was around that 70 US cents mark. We saw global markets dismantled significantly in the early phases of the COVID-19 global pandemic. That dismantling of markets obviously led to a whole heap of mass selling across the spectrum. And as a result, we saw the Australian dollar dip to lows not seen in close to 17 years. So we've seen asset classes disrupted significantly. And really in the aftermath of that initial disruption, one thing which has been really clearly evidenced across global markets has obviously been the response by central banks as well as, I suppose, global governments across the board. So really currencies like the Australian dollar have responded profoundly well off the back of that response, to the point, frankly, where a lot of the ground lost has been recovered. And in a lot of circumstances, asset valuations and exchange rates now sit at levels above where we were sitting at the beginning of 2020. And the reason why that response has been profound, again, has been off the back of the level of support which has been provided to markets. If we look at geographies globally, be it Japan, the United States, Europe, and as well as locally here, firstly, central banks have basically, they've intervened in markets and they've cut not only interest rates to record lows, but they have in some circumstances started to explore some alternate monetary settings in the form of quantitative easing. Something that Eleanor was going to touch on quite deeply in later parts will obviously be more so from a fiscal response. So what governments have done in response to this pandemic. All of these things have really led to massive levels of liquidity support, massive levels of credit support, to a point now where markets have been elevated and they have been propelled, as I said, to levels beyond where we were seeing pre-COVID-19. Off the back of that response, as I said, we have an unheralded or an unprecedented level of fiscal and monetary support. And frankly, the investment community have really responded in earnest off the back of that level of support. Where we are now at the moment is to say that at the beginning of the year, markets were acting rationally. Where we are now is to say that we probably are operating with a heightened level of volatility and without doubt, a heightened level of uncertainty as well. Market sentiment across the spectrum has played a really big part in supporting where we are today, which is to say that from an economic perspective and from a fundamental perspective, there are a lot of concerns around what the second half of 2020 is going to look like. And naturally, there are a lot of concerns in terms of what 2021 and beyond is going to look like as well. But really, market sentiment has been driven by interest rates, has been driven by the fiscal support. And as a result, currency markets and equity markets in particular today are sitting at elevated levels versus underlying fundamentals. So sentiment at the moment is very optimistic, and it has to some extent fueled this post-COVID recovery. In terms of what this the outlook for the Australian dollar being. Now, I think if you were to ask me that question, again, the bias was quite heavily slanted towards a declining Australian dollar. Where we are today is a little bit different. And where we are today, I suppose, is to say that we're a little bit on the fence, if we're being frank, which is to say that the market has recovered. The Australian dollar now is sitting almost at a 15-month high, but it's sitting at these elevated levels masked with a whole heap of uncertainty. And the two key things which are really supporting the Australian dollar at the moment, firstly is commodity prices. So what this graph actually doesn't illustrate it, but if we were to illustrate a different graph, what it would show is that a direct correlation between the strength of the Australian dollar and the strength of commodity prices. The two almost work in perfect harmony. And at the moment, commodity prices are playing an excellent role in supporting the Australian dollar. Where some of the uncertainty kind of creeps in for the Australian dollar again is a recognition that the Australian dollar will always historically do well when global economies are fundamentally operating well. And if you were to take a view right now that there is a whole heap of uncertainty around how the economy in a broader sense is going to perform, then again, this is where some uncertainty starts to creep in. If you're factoring some concerns around what's happening locally versus what's happening in the US, then there may well be an argument to suggest that it's not going to be a smooth and upward trajectory from here for the AUD. So I think commodity prices in this environment matter, as does your view on future economic expectations. Those two things are critical in determining where the AUD is going to head. I think if you were to take the COVID-19 environment out of this conversation, one thing we typically speak about very actively with our customers, and what broader markets will always speak about, is the exchange rate versus interest rates. Whereas interest rates do play a fundamental role in determining what exchange rates are going to look like over the longer term. Not just interest rates, but more importantly, interest rate differentials. And what this graph again shows is that if the US interest rate, by example, sits above the Australian interest rate, then again, there's a natural motivation to hold US dollars, to sell Aussie. There's a natural motivation to store cash investments in US dollars versus AUD because there is a zero risk return in doing so in the form of higher interest rates. So interest rates over the longer term matter, and still at this stage, quite surprisingly, the interest rate differential favours the Australian dollar, despite the fact the RBA has cut 5 times already this year, and despite the fact that we are at record low levels in our own right. So I think, I suppose, just in rounding out an assessment over where the Aussie sits, not only do commodity prices matter, but I think also, as I said, our view on what's going to happen in the second half from an economic sense, and obviously what's going to happen beyond 2020 as well. And I think we're starting from a very low base in terms of expectation. We know COVID's obviously had a dramatic impact on global societies and global economies as well. We're starting from a very low base of expectation, and already we're at a 15-month high. So you can start to get a sense that, hey, if you're in the favour of the economic trajectories upwards, it's going to support AUD also heading upwards. If iron ore prices stay consistently high, again, you're probably also in that bullish boat. But I think all of this conversation speaks to a fact that words like uncertainty, words like volatility, I think in previous environments or previous cycles, they were frankly a little bit overused. But I think in this environment, it is absolutely accurate and absolutely astute to assume that the face of global markets will change, I think, a little bit more fluidly than probably what a lot of businesses have been accustomed to over the last couple of years. Because the reality is events like the GFC of 2008, like Brexit of a couple of years ago, which frankly is still ongoing, and again, events like COVID-19, these things do change dramatically the landscape. Not a lot of businesses have the experience of operating through these types of environments. And again, it's very difficult to assess what the impact over the longer term it's going to have on the AUD right now, because we are frankly only 3 to 4 months into this environment. So I think I'm not going to spend too much further time talking about the outlook for the Aussie and global markets, but it was probably remiss of me to state there's definitely opportunities to ask some questions around markets and obviously around currency risk management towards the back half of this webinar. So I think firstly, we talk about markets quite regularly with our customers. The reality is that what is happening in the market really does matter. We always encourage customers to have I suppose, a degree of awareness over what's happening in the markets, because ultimately they do impact, exchange rates and really what happens with exchange rate fluctuations? You know, obviously it does stem to conversations around FX risk and what that can actually mean for a lot of businesses. So what we're going to do, we're going to jump into, I suppose, a bit of an understanding around currency risk, and also provide everyone with hopefully a couple of little data points that everybody can step away with today, and a couple of useful tips that you can kind of reflect on and hopefully look to put into operation. What we'll also do as well, we're going to try to create a little bit of framework, to kind of create some considerations that, again, a lot of businesses, if you're not thinking about these types of things, you know, we'd encourage you to start doing so. And there's a real opportunity here to, you know, partner with either a specialist or utilize more an existing relationship to kind of have conversations around currency risk planning and currency risk management as well. So on this topic of currency risk management, the rational place to start is basically understanding what is FX risk. Now, some of you might be thinking it's an elementary question, but the reality is FX risk, in very simple terms, it does refer to the losses that an international transfer may incur due to the fluctuations in the value of two different currencies. Now, what this graph basically illustrates is the difference in exchange rates between January of this year versus April of this year. Now, again, if you're an importer, if you're a business more broadly that was to transact in April versus transacting, well, sorry, I should say a business that transacted in January versus a business that transacted in April, on a relatively small parcel of currency, be it 20,000 US dollars, you can see that the monetary impact of transacting in April versus January is to the value of 3,400 Australian dollars. And that is a material impact on businesses' bottom line. So FX risk, very simply, it can be described as either the loss of activity or, frankly, as well, the loss of inactivity. So it is essentially a definition against what your currency choices are. So as I said, one of our motivations today is to provide a little bit of a framework around how we would have a conversation around currency risk management. Moving beyond what FX risk is, as I said, the next part of that would basically speak to businesses understanding, again, in where possible, a very simple sense, what businesses' own preference or risk profile looks like. So on the spectrum of, I suppose, a business which is risk adverse, you know, versus a business which is, you know, frankly, quite tolerant to a higher level of risk. What we can typically do with a lot of businesses is just simply make sure that they are asking themselves the right types of question and the right profiles of questions so they can frankly determine where they sit on that risk profile. The reality is not all businesses are created equal. Not all businesses operate against the same levels of competitive intensity, and not all businesses enjoy the same levels of price elasticity. You know, which is to say some businesses are better equipped versus other businesses, frankly, to naturally stomach or naturally operate with heightened levels of risk. And that isn't the case for all businesses. So when trying to fundamentally understand what your risk profile should look like, you know, versus your own optics or your own determination, again, you may well be looking to ask yourself some basic questions, but frankly, some big questions. And some of those questions will typically look like what we've got here. So, for example, what is the competitive environment in which you operate? Are you operating a monopoly, or are you actually operating in a hyper-competitive environment? What type of ability as a business do you have to adjust your operating margins, or to in fact pass on any exchange rate movements to your end customer. All the way through to basically understanding as a business, what are the consequences of your FX exposure? And this again comes back to understanding the consequences of an activity versus the consequences of too much activity. Organisationally, are you facing financial instability? Is this going to impact your margins? Is it going to impact as well the level of your competitiveness? Now, the issue around competitiveness in asking yourself the question might not be an obvious one, but I'll give an example of a business who, for example, in this COVID environment, overhedged in a falling AUD environment. What that essentially created was a consequence where businesses have purchased at super low exchange rates and they've been hyperactive in their response in a falling AUD environment. If you're a business, by contrast, who didn't do that, then you would essentially have had the benefit of picking up improved exchange rates, and that can filter through all the way through to how you price versus your competitors. So if you are able to achieve above satisfactory exchange rate outcomes over the longer term versus your competitors, that is by its own nature a competitive advantage as a business. So as you move through an understanding of what FX risk is, as you move through what your appetite for that risk is as well, again, it comes back to setting some really basic and some really important objectives. Now, one of the biggest common mistakes that we see businesses make is that their success from an FX perspective is too often baselined against today's market. But what businesses should look to be doing is baselining success against the objectives that they set. Objectives should ultimately set the course for what success should look like. And again, when we talk about objective setting, we talk about effective risk management, it comes back to being very disciplined and very true against your objectives, instead of making, frankly, decisions based on what the markets of today are telling you. So I think we'll pause there briefly just to say objectives matter. And I do want to run the group through, I suppose, a couple of common objectives that we do see used quite frequently across our customer base and equally across the industry as well. One of the most common objectives businesses will typically look to use is setting a target rate. Now, we'll use the example of an importer. Let's say going into this new taxation year, they make an assessment on what their US dollar cost base will look like. Now, if I'm an importer which has $1 million of US exposure expected over the course of the next 12 months, they may well seek to set a target Aussie US exchange rate against that cost base. Now, by setting a set target exchange rate against that cost base, that creates Australian dollar certainty for that business. It allows that business to operate and, frankly, be more concentrated against other variables outside of an obsession over today's spot market. In this example, a business might look to set a target rate of 68 US cents, slightly below the market today, and they will basically set an objective that they want to, over a 12-month period, receive an average exchange rate against that parcel of exposure at 68 US cents. Once you've set that objective, you've got Australian dollar certainty over your cost base, and you can basically set yourself up with your FX partner and with your use of products to ensure that you are competitive against that objective. What other businesses might typically well do is to set a hedge ratio. Now, a hedge ratio, using that same example of an importer which has $1 million US worth of exposure over the course of a year. they may look to set a hedge ratio, say 60-40, which is to say that they are actively hedging 60% or 600,000 US dollars worth of that exposure throughout the course of the year. They've got absolute certainty or absolute visibility from an exchange rate perspective versus 60% of their exposure. And they are actively participating in the spot market on the other 40%. So by having, by example, a hedge ratio of 60%, again, they're removing volatility, and equally they are allowing participation on the other 40%, which is to say if the market moves above their targeted rate, they can participate and they can pick up those nice gains throughout the course of the year. Now, it's really important to talk about two common objectives, not in isolation, but these two objectives can be used together, which is to say businesses may look to be setting a targeted rate in conjunction with a hedge ratio. Using my same example, a business could comfortably set a hedge ratio of 60% and then equally set a target rate against that 60% hedge. And again, that way they've got participation and equally protection at a set rate against a set amount of their exposure. So they're creating certainty whilst at the same time creating opportunity. Those two objectives are very basic and things that we do see used in operation every single day. Before I pass over to Eleanor, I think I'll definitely share a couple of tips and I suppose a couple of examples that we see play out in a practical example, frankly, every day. But before we get there, I think we've talked roughly around objectives. We've talked briefly around the importance of partnering with an FX specialist. But the way that businesses can protect against objectives is frankly through using the right mix of currency tools. Now at OFX, we offer quite a few, I suppose, money transfer options. We do also, I suppose, complement those with some currency management tools. Now, again, I talk about a mix of objectives being a hedge ratio and a target rate. I'll use the same message when talking about an optimum mix of transfer options and currency management tools. The two can be used harmoniously together. This isn't a conversation of all in or complete inactivity. It is a conversation over using a mixture of spot transfers, a mixture of limit orders, combined with the use of forward exchange contracts as well. You may well be used something like a forward exchange contract against your hedging or fixed or objective rate. So forward contracts, for example, they do allow businesses to secure an exchange rate today for a known amount of currency today for a future defined settlement date. So if I use that same example, if I'm an importer which has $1 million US worth of exposure, you may well look to use forward exchange contracts for 60% of that exposure. Forward exchange contracts will equally help you defend or protect against that targeted rate. For the portion of your FX that you're looking to actively participate or remain unhedged, again, you can use a mixture of both spot transfers, limit orders, and forward exchange contracts as well to participate if and when there's benefit in doing so. All of these money transfer options, again, combined with things like rate alerts, as well as all the information streams providers like OFX can give you in the form of daily and weekly commentaries, as well as online quoting and our online app. All of these things are very useful to help you make informed decisions when making currency choices. So before I pass to Eleanor, look, I think a couple of final tips for everyone to remember, and really some of these tips have basically been they've been put together over a number of years, having conversed with customers through a range of different cycles. I think the first tip to remember is, in earnest, try to make rational and measured decisions. We were again reminded of this not playing out in a live sense during those first waves of the COVID environment. It's unfortunate that the atypical response when the Australian dollar is falling is that typically the use of hedging products will increase. Again, a methodical and a very disciplined and practical approach to risk management should basically say that you are making decisions against your currency plan. And yes, they may well be refined when risk events surface, but they certainly aren't thrown out the window. And this comes back to being very rational in how you make currency choices. What you may well determine when things do start to get a little bit complicated or when volatility does increase, like we saw in March, is that you may well simply look to readjust your hedge ratios, for example. Leading into that type of environment, you may have been a business which hedged 50% of your exposure and participated in the spot market for the other 50%. When things do get a little bit scary, you may well look to simply reassess that ratio. Is 50-50 appropriate? It may well be when things get, again, a little bit bumpy. You might shift to a 60-40 hedge or an 80-20 hedge. But really, you don't want to deviate completely from a predetermined plan. The second tip is obviously be situationally aware. And it's just to say there's a reason why we encourage customers to be informed, and there's a reason why we speak quite openly and actively around what's happening in the markets of today. Because ultimately the spot market is important. Expectations over future outlooks are important as well. So just be aware of the dynamics within the global markets of today. The third tip here is a reminder to everyone that time is your friend. Now, time is your friend both at a transactional level, but equally over the course of a broader period, be it 12 months. If you're an importer, by example, which gets given an invoice on day one, the terms of that invoice might mean you've got to make a 10% commitment for a deposit payment on day one, but frankly, you're not obligated to settle until 90 days' time, where the other 90% of the payment is due. What we too often see is that a business might well receive an invoice on day one, and they're almost forced into a decision to cover the full amount of that exposure for the full time frame of that exposure on one particular day. So essentially what that business is doing, it's creating risk on one day for the full period of that invoice. And again, one of the key objectives of effective risk management is to ensure that you are, again, over the longer term, achieving an averaged rate. So in that example, what an importer might choose to do is to break that payment down into lower payments, but higher frequency payments. And a way to achieve that would be to look at layering your forwards all with a set maturity date. But over time, even if it be a short period, be it 6 weeks, you might well see the exchange rate fluctuate between 68 US cents and 72 US cents. But if you have multiple forwards for smaller tranches of currency, all maturing on settlement date, equaling the value of that invoice, then again, what you will see is a nice averaging impact through the full course of that 6-week term. Yes, you're giving up some upside participation, but equally, again, you will likely avoid some of the nasty lows you'll see throughout that period. So whether you've got exposure over a short period of 6 weeks or a longer period of, be it up to 12 months, use that period to smooth out the edges. And again, product use and objective setting can be really important to use that time to your advantage. The final tip here is around obviously just an acknowledgement, I suppose. Risk management is not a perfect science. I think the benefit of having this conversation now is that obviously a lot of businesses are very early in their new tax year. It is a really great milestone in everybody's calendar, basically just to look back on last calendar year's performance. Make an assessment in terms of how you went. Did you achieve satisfactory FX outcomes sheerly by luck? Did you achieve satisfactory FX outcomes, by your own activity? And frankly, what do you want to be doing better or differently this year? And again, that's something that, the likes of OFX, frankly, can help you with to some extent. Look, I think just finally, don't overlook any opportunities to net and offset. Again, a lot of businesses may well be operating globally. They don't just have cost bases, but they may well have revenue bases sitting offshore as well. So when there is opportunity not to create FX risk, then obviously we'd recommend taking it. I think, look, we've covered a fair bit of ground. Everything we've covered was basically designed, as I said, to start the conversation around FX risk management. As I said, operating a business comes with operating a whole heap of different variables. And what we have definitely observed leading up to this big dismantling event, be it COVID-19 back in March, is, I suppose, a general sense of complacency. As I said, when when markets are acting rationally, when currencies are in a relatively well-behaving state, typically businesses they will tend to forget about some of the the ugly things which they can be blindsided by. And again, this is about making active choice and not necessarily being forced to make decisions if and when volatility does flare up. So it's all about getting ahead of some of the risks which we know will obviously sit on the horizon. All right, I'm going to pass over to Eleanor now. As I said, she's a proud partner of the OFX family, and there'll be an opportunity in later parts to ask any questions.
Thank you, Michael, and thank you, OFX. It's a pleasure to present to you today. I will be going over tax and Australian SMEs, just talking through some of the most recent stimulus measures, some of the tax issues related to Forex, as well as some of the advice that CPA Australia's members and the organisation itself is making available to businesses in this COVID-19 environment. So, when we think about COVID-19, I think Michael's covered it really well. It's all about uncertainty, perhaps a little bit of irrationality, and also a lot of businesses not quite knowing whether their plans are going to hold, having the confidence to move forward as they had planned, or whether they need to readjust. So the government has come through with stimulus measures, and many businesses are perhaps in the unfortunate position of availing themselves of JobKeeper, which last week they announced would continue until the 28th of March. So for businesses who are accessing JobKeeper, that will be available, but with new tests and declining payment amounts commencing from the 28th of September this year. The government's intention is, with all the support, they still hope and are predicting that Australia will come through this and recover. And while I'm located in Victoria, which is in a different position to many parts of Australia, the overall picture, the government is counting on both Australia and the global economy to head towards a bit of normalcy in the coming months. The cash flow boost, which was also announced earlier this year, the second tranche payments are now coming through. So those are amounts between $20,000 up to $100,000 for businesses that report pay-as-you-go withholding. So that has also been reported to be quite beneficial, and that's just been a simple cash injection, no requirement to pay employees or anything like that. It just is coming through on activity statements. The instant asset write-off, which was lifted up to $150,000 threshold, has now been extended to 31st of December. And that's been a really valued extension, because at the time when COVID first hit, many businesses weren't quite sure what they would do with their capital investment choices. They weren't sure whether or not their supply chains would be normal enough to actually take delivery of any capital assets that they ordered, especially from overseas. And so this extension to the end of this calendar year and into the 2020-21 financial year means that businesses now have a few more months to reassess where they stand right now and make big investment decisions should they so choose. For the assets that are more than $150,000 or for those larger businesses, the Backing Business Investment Initiative is also available. So that's accelerated depreciation, and that again is intended to encourage capital investment. So the government is anticipating that between JobKeeper and all of the cash flow boost, instant asset write-off and backing business investment measures, that businesses will remain confident they will be able to maintain some cash flow. And with JobSeeker and other income support initiatives, as well as the state government grants, the intention of government is that Australian businesses will come through this in a okay position. And by all accounts, we have been speaking with our members, our public practitioners, and they're actually reporting a mixed bag. So some businesses have actually done really well in the sense that the markets and the businesses that they operate have actually experienced an increase in demand, and many of those are online businesses or those that are trading globally. So depending on the movements in the market, depending on where the businesses are targeted, some have experienced increases, others are doing okay, while obviously, unfortunately, certain sectors have been really, really hard hit. So moving on to just international trade, Forex and tax more generally, I think Michael summed it up well when he talked about expert advice and specialists and also setting objectives and risk management. Quite often tax for business can be an afterthought, but in the areas, well, actually in all areas of business tax, but especially things like foreign exchange, international trade, tax is an important consideration, and it's always better to get professional advice and to think through the tax risks and the tax obligations as you commence your exposure to overseas markets and as you enter into financial transactions, products and platforms. So in the Australian tax laws, there are a couple of divisions and subdivisions that cover foreign currency tax, or Forex measures as they're more commonly known. There are two aspects to it. One is your translation rules. So if you're earning income or paying expenses in a foreign denominated currency, you need to translate those into Australian dollar values for tax purposes. And those can be done, the ATO will publish daily or monthly exchange rates so that you can make those translations. And that is required because at the end of the year, when you lodge your income tax return, and for potentially other tax obligations as well, you will need to report those in Australian dollars. There are also a series of transactions called Forex realization events, which are particularly applicable if you hold accounts in foreign currencies. So quite often when you do have those exposures, depending on how you structure your foreign exchange and your foreign currency assets, you will need to stay on top of whether or not you have those Forex realization events, whether there are elections that you can make to make things easier for you, such as the $250,000 balance election, and make sure that your records are kept in order and that you do actually have substantiation so that when you go to do your tax return or most likely go to your accountant or your advisor, they will be able to work through how your transactions are going, how they need to be reported for Australian tax purposes, and how they could be treated. The other thing is, depending on the complexity of how you structure your foreign exchange transactions, there may be tax planning opportunities in the sense that different exposures, different products, different obligations may give rise to different tax outcomes. So once again, it's important to speak to a professional tax advisor with experience in foreign exchange and international trade to make sure that you're making the right choices with your tax side of things and you're reporting and treating it correctly. I've talked about the stimulus measures. There are a range of tax issues arising from COVID-19. So once again, different businesses have been affected in different ways. The volatility in currency markets may have increased some of the gains and or losses from foreign exchange exposures for many businesses with international trade. There are also issues with losses and bad debts, depending on whether or not your suppliers have been paid, whether you are getting paid by those that owe money to you. So things like trade receivables, your current assets, your current liabilities, all of that side of things needs to be monitored, because again, there are tax issues that arise from that. And if you have experienced as a business a large shift in your economic circumstances or your business performance, those need to be drawn to the attention of your tax professional, and they can help work through any tax consequences and potentially also the tax benefits, in the sense that, okay, you made a loss this year, but you can carry that forward. How do you treat that, and how do you offset it in future years? There are some recent changes on vacant land deductions for those who have property overseas, who are overseas residents. There are changes to property laws. Things like the R&D tax incentive for many small Australian startups, those changes remain on hold. Division 7A changes for private businesses have also been announced to be put on hold until royal assent, and we don't even have a bill. So there are a range of tax issues that have not progressed simply because of COVID-19, and we would expect the government to be a little bit clearer about what they're progressing and when in the October budget, and hopefully come forward with a clearer economic plan, some clearer tax guidelines or tax ideas, and see what happens in the October budget, recognising that we are now in recession, we do have an unemployment problem, and we need to see how the next few months go in terms of our recovery. And so on the side, on the perspective of businesses, so CPA Australia is more than just tax. I do tax, but obviously our advisors do a whole heap more than that. So we have produced a range of material in relation to reflect, reimagine and reinvent. So this recognises that a lot of businesses at the moment are, you know, in a space of uncertainty. So they might be reevaluating a lot of their existing plans, a lot of their existing business practices, but this isn't actually a bad thing. Taking stock of where you're at, I think Michael alluded to it really well. When you have a currency plan, or you have a business plan, or you have a marketing plan, and COVID-19 has really tested some of those boundaries, it's a good opportunity to just sit back and reflect on what you've set for yourself, and whether it's still okay, whether you need to tailor it, or whether you need to actually get a different mindset or a different perspective on how you want to approach the future. So a lot of Australian businesses we're hearing are pivoting. For many importers, they've actually started to think about, well, do I actually want to start finding opportunities to export? Are there other markets? What can I do outside the Australian environment that can improve my business at a global level or access new customers? So strategic planning, measuring where you have been and also how you might go forward. Just the organisational structures and human resources. Unfortunately, when revenues decline, profits decline, businesses do have to look at their staff, their structures, how they're operating, all of their selling, general and admin costs, and just see whether there are efficiencies or different ways to be doing things. So we've got a range of resources on our COVID-19 hub, which talk businesses through, as well as our CPA members can talk you through this as well, the things to consider when reevaluating your business, which then goes to really looking at your financials and having discipline over your financials. So profitability, cash flow, liquidity, solvency. We actually recommend, depending on your market, depending on your business, depending on how much you've been affected, you might even want to be looking at these numbers daily. So we're not talking monthly or at the end of the financial year, we're saying daily. Really, really watch how your business is going. And I think that aligns really well with the foreign exchange. You want to be looking at how the markets are moving, how your risks are changing, so that you can continue to modify and tweak what it is that you're doing. That external environment, there is an uncertainty, but sometimes you can plan for uncertainty. You can actually say, well, if I don't know what's going to happen tomorrow, as a business, what am I comfortable with? And once again, I think Michael covered that really, really well. Then we go through to business recovery. hopefully most of Australia, most of the businesses are starting to look to the other end of COVID-19. So what is the business model that you want to have? What are your long-term goals? And some of that might actually include divestment or acquisition if you actually have the ability to acquire. So our advisors, our members are reporting that there are restructuring opportunities. People are looking at what is their core business, what are they best at, and how can they dispose of things in a tax effective way, how can they restructure in a tax effective way, and unfortunately some will actually be choosing to exit. So how do you exit in an orderly fashion, preserving as many assets as you can and doing it the right way so that you don't get in trouble with the tax office and other regulators down the track. The other thing is also, once you come out of uncertainty, there is that opportunity to think about the lessons that you've learned. And the other thing that we're looking and hearing a lot about is technology. So Australian businesses tend not to be as digitally focused as some of our overseas counterparts, and COVID-19 has really pushed use of technology and digitisation of business models forward. And how do you leverage that and how do you build on that? So like I said, we've got resources on our resource hub. Our CPA Australia members, our public practitioners do provide business advice. Find someone who has the experience in your industry and can provide services that are tailored for your needs. And with that, I will hand back to Michael, and thank you very much.
Thank you, Elaine. That was fantastic. Eleanor, sorry, I should get your name. My apologies. Thank you, Eleanor. That was, as I said, that was fantastic. And of course, there is an opportunity there for anyone that wants to jump onto the CPA Australia COVID-19 Resource Hub. The hyperlink is in the deck for everybody. So for those interested, please jump in. We will open the forum for some questions if there are any. Again, between Eleanor and myself, would obviously be happy to answer any questions if there are any. So we'll give everyone an opportunity now to pitch any across.
We've had one that's just come in, Michael, which is a question around accessing these tools and these products, and are they available to book within OFX's digital platform?
Great question. Absolutely. So what I'd encourage everybody to do is that to contact OFX. There is capability to enable all of our transfer options and risk management tools via the mobile platform. So absolutely there is. It just needs to be functionality turned on, which we'd be happy to organise.
Thanks, Michael. I've just had one more, which is in relation to the markets currently, and what your perspective is on the trade tensions that we see happening with the US and China and the impact to the Australian dollar.
Yeah, look, it's an interesting one. Obviously, these debates, the US-China trade debate, as well as obviously how Australia have been caught up with the increasing dialogue between Donald Trump and his counterpart. As I said, it's been an interesting narrative. I think it's really important to note at the moment that China still remains a strategically very important trading partner to China. They still do represent around 35% of our entire export market. And obviously that is again tied to that commodities narrative that I spoke to briefly earlier. But I think at this stage, again, demand hasn't been impacted too heavily. There are obviously concerns as trade restrictions and tariffs do increase, or should they increase, then obviously that is going to be, I suppose, restrictive to the Australian dollar's plight moving forward. But at this stage, again, demand impacts have been relatively limited, which is a positive. And again, obviously, the underlying price of commodities being elevated as to where they are now, still that is playing a good role in supporting where the Aussie is. So yeah, I think it's definitely one to watch. I don't think it's one which is necessarily going away because increasingly at the moment it is apparent that there's not necessarily an exit door for this theme, which has been in play for you know, almost 12 months already. Okay, I think that's all the questions that have come through. Again, a very big thank you to everybody that joined today. A very big thank you again to Eleanor for her participation as well. If there are any questions which the group would like to take offline, again, there is that resource hub which we referenced through the CPA website. Equally, please feel free to get in contact with OFX, either by your existing account manager or through our 1300 300 524 line. Once again, thank you very much. We look forward to being in touch.